Okay, great. So welcome everybody to our webinar on maximizing PPP loan forgiveness and maximizing the longevity of your business. Our company is called ProfitLink. We do CFO advisory and crypto accounting for blockchain and tech companies, as well as we have an arm that works with professional services and trade companies as well. My partner, Mel Kilmer, is joining me today. She's going to be working the background with the chat functions, and I will be doing the presentation. We represent the leadership team at ProfitLink. We have a team of CFOs and accountants, and we do outsourced accounting and finance services for small and mid-sized companies. Okay. So one disclaimer before we start. This webinar obviously is for informational purposes only. It's not really intended to provide tax or legal advice. You should consult your tax advisor or attorney. And then the other caveat is our recommendations today may change as the guidance is released by the SBA and the Treasury Department. If you have gone through the loan process of applying for the loan, you probably know how much back and forth there was on what exactly is included in that calculation. There's an equal amount, if not more, when it comes to loan forgiveness. So if you were part of that process and you had an advisor working with you, they were keeping up on all the changes that were happening with what's included in the payroll calculation. We have it, as guidance came out from the SBA. There's yet to be guidance coming out from the SBA regarding loan forgiveness outside of a few snippets here or there in the documentation that's currently out there. So we expect more to come out. So what we're suggesting today may change based on future guidance that's coming out. Okay. So let's talk about what we're going to cover today. We've got a lot to cover. First, we're going to start with the payroll cost definition, just a refresher, and the use of the funds that are required. We're going to talk about 4 components that make up the PPP loan forgiveness. We're going to talk about calculating the reduction of employees and salaries, how you can get an exemption for rehiring the staff and restoring their salaries and headcount. Also, the documentation that we think is required for the PPP loan forgiveness to make sure that when it comes time to present your documents to the bank, everything is in order. And then we've also gotten a lot of questions in the last week or so about, okay, great, I got this money, it's sitting in a bank, what do I actually do with it? Sometimes some people are like, okay, I was going to hire everybody, but now I'm second guessing that. So we'll go through some strategies around how to use the PPP funds. Okay. So just a refresher of defining what is considered payroll costs in the payroll calculation. The good thing is the payroll costs that were associated, which were used to derive your actual loan amount, obviously is what we're going to use for the loan forgiveness amount. So I'm not going to read all of these, but basically, it's your salaries and wages and the benefits and retirement benefits, adding also the state and local taxes. Another important definition outside of payroll costs is what is that covered period? And the covered period is the 8 weeks from the time the money is deposited into your bank account. So I know for some of us that's not exactly ideal. We're still waiting for the recovery, but yet we have this money sitting in our account and we have 8 weeks to spend it in order for full loan forgiveness, assuming you meet the criteria we're going to talk about in a little bit. So one of the questions that I've gotten over the last week is, when does the clock start ticking? It's from the time the bank has deposited that money into your account, okay? When you did your loan application, you had to attest that you would use the of the loan for payroll and allowable non-payroll expenses. And those non-payroll expenses that are allowed to be forgiven include mortgage interest, rent, and utilities, but that can only represent 25% of your loan forgiveness, okay? So, so you have to use non-payroll and then these allowable non-payroll expenses. Okay, so let's get into the nitty-gritty. The 4 components of loan forgiveness. We already talked about how the non-payroll costs have to be capped at 25% of your loan. There's a component talking about or a calculation regarding reducing headcount. There's a calculation for reducing salaries or methodology for reducing salaries, calculating that impact on your loan forgiveness, as well as restoring headcount and salaries back to the level of as of February 15th. So let's go in deeper into that first component or the second component, which is determining the forgiveness if you reduce the number of headcounts. Okay, so the amount of your loan, say if you started at $100, you start chipping away at that for both if the number of employees has declined. So the SBA has some guidance out there related to, the law actually talks about how you calculate that. But what I'm going to tell you is I think the law has more questions than it answers. So we're going to talk throughout this presentation more about the, about the areas in which there's more questions that we've determined that still need to be clarified. And the important part of that is for you guys is, so when you're making these headcount decisions, whether you're reducing staff or adding back staff that you've let go, you take in consideration, hey, this thing may change, or hey, this isn't clear, so that you're taking calculated risks when you're putting your headcount back or reducing. Okay. So when it comes to declining number of employees, the loan is reduced by the percentage of, where you're, basically it's where you're ending at 8 weeks compared to one of 3 options of a look back period. Okay, so it's taking your average number of full-time headcount per month during the covered period divided by, and you get to choose what's the denominator. What period do you want to compare it against? February of 2019 to June of 2019, your headcount for the first month and a half of this year, or if you're a seasonal business, the look back period is February to June of last year. Okay, so you have the option, and of course you want to run the different scenarios to find out what's going to give you the highest percentage of loan forgiveness for the number of headcounts. Okay, that will get you the adjustment to your loan. And what is outlined in the law is the definition of average full-time equivalent is the full-time equivalent for each pay period falling within a month. Okay, so the next natural question, of course, is how's full-time equivalence determined, right? Is that a 30-hour week, which is more in line with the CARES Act? Is that 40 hours a week? How does overtime factor into that? My assumption is that everyone's going to be calculating FTEs differently unless there's some sort of guidance out there. So know that this could impact your calculation one way or another. It's interesting, in the law, it talks about full-time headcount, but the SBA normally uses actual heads for size classification. So if you have a full-time person and 2 part-time people, you would have 3 people. Whereas a full-time equivalent, let's just say those 2 part-time people were working half a full-time schedule, you would have the equivalent of 2 full-time equivalents. So there's a lot of questions around what is an FTE and what is the calculation. Are we using actual heads or FTEs? I think that's also going to be clarified. Okay, so that was the reduction if you reduce the number of heads. And that was relatively simple. The salaries, the reduction if the salary and wages, that if they decline, that's a little bit more complex. Okay, so this is a summarization of what's in the law. If you reduce any employee's salary or wages by 25% from the most recent quarter, that amount is deducted from the loan, and these are in dollars. The head count was a percentage. This is in actual dollars. So So what's interesting in this, what the SBA goes on to explain then is what it considers an employee. And an employee is any employee who did not receive an annualized rate of pay in any single pay period in an amount greater than $100,000 during 2019. Okay, so one of the things I want to just take a step back. When we were helping our clients determine what the payroll calculation is, we kept taking a step back and saying, what is the spirit of the law? Knowing that there were some contradictions within the law itself, and then also the guidance that came out after. So our interpretation of this forgiveness component is that the spirit of the law is that it is trying to protect the low-income earners, anybody who's earned less than $100,000 last year. Okay, so those are the ones that they're honing in on as far as, you know, being careful about the salary and wage reduction. Okay. Of course, that triggers more questions, right? So, you know, what happens if your employees' earnings are lumpy? Let's say they earn less than $100,000 a year, but they get bonused quarterly for either compensation, a bonus, incentive compensation, commission, etc. You know, according to the law, if you look at the annualized rate of pay in a single pay period, that's going to push them over that $100,000 mark. So I think, again, that needs to be clarified, because otherwise you're going to knock out a whole bunch of people who I think the law was trying to protect. So if you have what I call unscientifically lumpy payroll, it's something you want to take into consideration and kind of identify who those employees may be. We're not sure if they're included or excluded from that calculation. But if you read the law literally, it only creates provisions and protections for those that are earning less than $100,000. So does this mean that if you can exclude anyone earning over $100,000? Like, so if you have somebody who's earning $100,000, $101,000, can you reduce their salary by more than 25% and not get penalized? According to the law, basically this category is eliminated. So you, in essence, could, for the salary and wage reduction, eliminate all your senior or more highly paid people and not get dinged in your calculation for that. That's the way the law is written. Now, most definitely that has got to be clarified as far as like who's truly included in the calculation. And then when they say, you know, any employee, if you reduce any employee's salary, do they mean actual people on the employee roster as of the previous quarter? You know, what happens if you fired and hired a different person for the same role and pay? Are they trying to track back by name, or is it by position and pay? Is it by just heads? Or, you know, how are they going to go do this look back to determine, you know, what the salary reductions were for your payroll during that 8-week period? Okay. So, and then the last piece is the whole program in the covered period is 8 weeks, 8 weeks of wages. You're supposed to check, does that 8 weeks of wages match against what we paid them before? But if you look at the period that the salary and wages are looking back at, it is for for a full quarter. So you're comparing 8 weeks to 12 weeks, doesn't make a whole lot of sense. Again, more clarification will start to come out. And it's very interesting because the look back periods for each one of these components is different according to the law right now. Okay, so now the last piece, so we talked about headcount reductions, we talked about salary reductions. Now this component piece that everyone has a question about is, okay, if I add my people back, if I pay them the wages and restore them to where they were before, what does the loan forgiveness look like? So it's relatively simple in the law, the way it says, if you reduce your full-time headcount, full-time equivalent headcount or salary of employees from February 15th to April 26th, and you, quote, eliminate the reduction by June 30th, the headcount salary reductions will be ignored. So the two previous calculations that we just went through will be negated if you restore headcount or salaries of the employees. Okay, so seems simple, but warrants a whole lot of questions. And again, we think that there's going to be more clarification coming up. So, common question is, okay, so if I eliminated the reduction for salaries, meaning I keep everybody off my payroll until June 29th, and then I pay them the back wages and will I still get the loan forgiven? Or do you have to hire everyone back before that 8-week period is over? That's the other question. And do you still get the loan forgiven? There is no provision right now do you get partial credit for restoring some of your headcount and salaries back to the February 15th level? We don't know that yet. And we see a lot of ways to game the system. The average number of full-time equivalents and salaries, adding people onto payroll that weren't on before. I think this thing is kind of the wild, wild west right now, and it's going to be locked down, bit by bit. So things like requiring an employee roster will prevent some of the shenanigans of gaming the system, adding people. You could theoretically have nobody on payroll for 6 weeks, hire a bunch of people to spike your average FTEs to meet the headcount requirement calculation. Again, back to looking at the spirit of the law. I think what the law wants, or the intent of the law, is to keep people employed. And then there's also some timing issues that I think is less of a risk, because I don't think there's going to be any money by mid-May. However, in the provision of the law, it says you have to eliminate the reduction by 6/30. If somebody gets the loan in mid-May, that 8 weeks will go past 6/30. I don't think there's going to be money back left by then, but we will see. Okay. So those are, that's the add backs. That's the exemption for the rehires. Again, lots of clarification needed. So, while we're trying to figure out, and as the situation is changing, we still can get our documentation in order. Okay. So there's some critical things. It's not really complex, but it's important that you keep the documents handy and well, let's say auditable, because we don't know what the review process is going to be like for the banks in the loans. Our understanding is that the onus is on the borrower to provide documentation, and the banks really don't have too much of a liability when it comes to the loan. So definitely you want to have documentation verifying the number of full-time equivalents on payroll, the pay rates for the periods described. We would say keep an employee roster as well. So most payroll companies have a payroll journal report, which will give you the information that you need. I wouldn't doubt that the payroll companies will come up with a PPP special report for you. However, given the challenges that we had when they were pulling together information for the payroll calculation, they didn't have it right until the very, very end, until, I don't know, I mean, it was, people had already submitted their applications and the payroll companies still had incorrect calculations. So we always like to say, go to your accountant, go to your advisor, have them do the calculations for you, because again, they're all kind of interpretation. And make sure that they're validating what the payroll companies are putting together. Okay, next thing is make sure you have documentation on the allowable non-payroll items. That's the mortgage interest, the rents, utilities, canceled checks, payment receipts, transcripts of accounts, other documentations, verifying payments. This also goes for, things that are included in, like your rent and your utilities, statements, checks, whatever, online bill pay, whatever it is, make sure you keep those. And you've probably heard this from your accountant or just generally, it's not a bad idea to open a separate bank account and transfer the exact amount for each expense to create an audit trail. So if you have $1,000 of rent and you have your PPP money sitting in a separate bank account, I would transfer $1,000 to the penny to your operating account and pay the bill out of your operating account. That creates a nice clear audit trail, so you're really etching down that balance every time you use it, whether you draw a payroll, pull it out at the exact amount so you have a good audit trail. Now, if you have a really sophisticated accounting team and they're pretty good at this, that might not be necessary. They may be able to track separately, say within QuickBooks. We've got some people who are using sub accounts to track the PPP money and take withdrawals out of that. Whatever way it works, just make sure that you can verify that the money was spent in the proper, that you have a trail. This is not a windfall. I think we all know this, but this is not a windfall from the government to say, hey, go out and buy a boat. We just gave you, $800,000, go buy a boat. No, it is, if you use it for anything else other than fraud, other than payroll and the allowables, you will be convicted of fraud. So it's super important that you have that documentation there because you don't want any room for error or questionability. Okay, so when we went through this process with the fine-tooth comb over and over again, just like we did with the payroll calculation, there's a lot of people are like, what do I do with the money? I don't even know how the loan forgiveness is going to be calculated. So there are really three strategies, I think, that come up with the PPP, what you can do with PPP money. And these are just high-level ones. We have another webinar we're creating around strategic uses of the PPP money. So we'll talk about that in a second. But, your option number one is spend the money. It's try to optimize your loan forgiveness and spend the money. And that means bringing everybody back on payroll to 215 levels, that's February 15th levels, both with headcount and salary, and wait for more guidance. We think this is kind of a risky option. I mean, it will maximize your loan forgiveness, but maximize your loan forgiveness the way it stands today with its own, nuances. But you'll still have a loan balance to pay off if your rent, mortgage, and interest aren't 25% of your loan. So for example, if you use 2019 calculation for your loan amount and you are nowhere near spending that for the 8-week period, you're going to have some loan left over, and you can offset that with your 25%. You can offset 25% of that with your utilities and mortgage, but you still may have a loan at the end of this. I think people are thinking, or kind of some of the insight I'm hearing is like, oh, this is just free money and I'm just going to get it all back. Even with the calculations the way they are, there is a very high likelihood that you will still walk out of this 8-week period with some sort of liability, some sort of balance. One of the other risks is if you try to bring everybody back, not everybody will want to return, whether they, just have found another job, don't want to come back to work, or what we're also seeing is some lower end, entry-level people or minimum wage folks, it's actually more lucrative to stay on unemployment than it is to come back to work. So they're getting paid more on unemployment than they would be working for you. So to try to entice them back so you can get that loan forgiveness is going to be a real uphill battle, I think. So, you may not get all those folks back. And then, we think there's ways you can stretch your PPP dollars depending on, how the calculations, some of the clarification that comes out. So like, can you take advantage of reducing higher level people's pay and not getting dinged to stretch those dollars a little bit more? If you go full bore and put everybody back on payroll, you're basically spending all that money and not taking advantage of those potential areas to stretch the dollars. And in this market, when cash is tight and banks are not lending outside of course, PPP, And the EIDL loan, or the economic injury disaster loan, doesn't look like it's getting funding, or if it is, it's weeks and weeks away. Cash is king. And so you have this cash and you want to make sure you're using it to the best of your ability. So if there are some opportunities within the calculation to stretch that payroll and not get dinged for the forgiveness, by going full bore, putting everybody back on, you may be doing yourself a disservice. Option number 2, outside of spend it all, is hold and wait. You can wait and see, keep your headcount and salary reductions in place. You can continue to do what you need to do for your business, pretending like you don't have the money, and wait for more guidance around some of the rules. But the risks associated with that is that, if you keep everybody off of your payroll, your full-time equivalent headcount calculation, which is part of the loan forgiveness, might be deflated, and so you may not be able to reach the equivalent to the look-back period that is required. So that's one risk of keeping everybody off payroll. But if you decide, we have some people who are thinking about doing a hold and wait strategy where, hey, we'll keep everything status quo, and then maybe what we do is we just make everybody whole again when we have better guidance. And in essence, and if you're trying to meet your 8-week target by getting that money refunded, you maybe have to pay people for doing nothing. So that's money that they even may be collecting unemployment, and there's no guidance around, hey, if they're collecting unemployment and now I have to pay them, they're getting a double windfall on the employee side, but also it's a double dip on the federal side. So we don't know how that's going to work. That's another point of clarification that still needs to come out. However, just from your perspective, if you take an employee who's been off payroll or collecting unemployment and now have to bring them back in order to meet your loan forgiveness calculation, you in essence could be paying them for 4, 6, 8 weeks of doing nothing, and now they get a windfall. So you may have to be creative with that payment, but there are some restrictions around it, so you have to be very careful. And also, when you're pulling back headcount from, when you're taking somebody, pulling back into the business, make sure you are consulting with an employment attorney so that you don't have a liability down the line. The third option is, of course, we're a little bit more biased to it, is really stop and use this opportunity to strategically use the money. And that means that look beyond just the PPP loan forgiveness and look at it as an investment in your people. Really having a well thought out plan for the money, knowing how you're going to use it and what will you have your staff do with the pay you're going to pay them, is really important. You want to make sure there's an ROI for the dollars that you're spending. We're actually seeing a lot of people being very creative, right? So there's, they're bringing their people back. There may not be work for them to do for their clients, but they're having them do a lot of internal, what I call housekeeping, whether it's literally cleaning the shop or sanitizing the shop, or fixing that file system that has been broken for years, or getting things filed appropriately, creating documentation around standard operating procedures, doing marketing, social media, research, things that aren't necessarily in somebody's wheelhouse, but kind of redeploying those people to kind of get some ROI for the pay that you're paying them. And it is a very dynamic environment now. I think I've said that too many times, but really certain guidance coming out of the SBA. Let's just go back to the loan application process. The guidance coming out of the SBA in some cases swung people's loan calculations, 20, 30, 40%. Okay. So you need to kind of be on top of that, and hopefully your advisor is doing that. We're doing that for our clients, is just keeping abreast of what's changing and how it impacts your loan forgiveness amount. So the new guidance that's going to come out is going to tighten the screws on some of these loose ends that we have. So making sure you are constantly aware of that, and it's not a set it and forget it type of strategy. You need to be dynamic in that. So we really feel like the focus should be balanced both on maximizing the loan forgiveness while maximizing the longevity of the business. 8 weeks is not a lot of time. It really isn't. And how do you think the economy is going to change in 8 weeks? I mean, our perception is that there's going to be a long tail recovery. You know, it's not going to be a bounce back like people were talking early on in the V. Oh, we'll get over this and it's going to bounce back to the economy. The damage is slowly, it's accumulating rapidly, I should say, but the recovery is going to be long. So if you spend all your money in that 8 weeks, what do you have at 8 weeks? The same situation you probably have today. You know, I don't think demand is going to ramp up so much that you can go back to full staffing as of February. I can't see it for most businesses. So going into this loan forgiveness, not being blinded by free money, but being open to the opportunity of how do I survive this to get to the other side, okay? So I want to be super clear. We are absolutely recommending that you use this money for the allowable non-payroll expenses and payroll, but maybe not all in 8 weeks, okay? So I'll say that again. You have to use this loan money for payroll and the non-payroll expenses, but you don't necessarily have to use it all in 8 weeks. So again, you would keep your documentation, you keep that separate bank account, you continue to pay your payroll out of that PPP loan, but you would then have more room to, for your cash flow perspective, to pay other expenses to help yourself ramp up, okay? You have options. If you don't use it all, you can pay it back, or it is a really good loan. Take advantage of the favorable terms. It's 1% for 2 years, a 6-month deferral with no collateral, no personal guarantee. You can't get that loan anywhere. So you think of it in that respect, not only on forgiveness, but on longevity for your business as a survival, as a cash flow mechanism for yourself, okay? And then we also talked about this a little bit before, was, using the money and the extra time people have to help make small pivots in the business, whether that's, maybe a line extension or ancillary service, or, I know people who are researching bigger pivots in their business. Again, trying to get an ROI for the money that you're spending on your people. I know we all want to do the right thing. I know we all want to get our people back to work. But we want to make sure that our business is around to survive, to re-employ those people long term. And this all, of course, ties into having a cash plan, a forecast, and also the dynamic PPP model, so you know your loan forgiveness amount and how that is changing over time. How much of a loan are you using? How much of it do you still need to have forgiven? And what your loan amount will be, plus your monthly payment, and make sure you're comfortable with that. This is kind of the stuff that we're doing with our clients to kind of keep them in this next phase of keeping an eye on the PPP. It's almost a separate financial strategy, is, managing your business, but then also managing the PPP and the loan, because, in some cases it's a significant amount of money. Okay, so like I said, we're here to help. That kind of ends our presentation. Anybody who wants to run their PPP loan forgiveness strategy by us, we're offering our attendees a 30-minute complimentary consultation. You can contact us at hello@ProfitLink. Mel is going to be putting our contact information in the chat function. And then I also want to invite you to some upcoming webinars. We have one on Thursday, which is about saving money through accounting automation. And then also a real short one on quick tips for cost cutting, that's on Friday. And like I said, probably next week we're going to roll out another PPP loan forgiveness webinar, but more talking about the strategic uses of the PPP funds and how you can, get some ROI on that as well. So I'm going to open it up for Q&A if there's any questions.
Yes. Hi, Anna. It's Mel. Hi, everyone on the phone. Thank you. We've had a pretty active Q&A session in the chat function, so thank you, everyone, for contributing to that. I don't know that we'll be able to answer every question in as much detail because some of them are very specific and we need a lot more detail, but we can start with, we'll start with some of the more broad questions and then narrow down as we go along. Question, and I'll just take some of these here. Does the employer calculate themselves up to 100K? And the answer, and Anna, jump in if I'm misrepresenting any of this or you have further clarification. The employer, yes, if the employer is paying themselves through payroll, yes, they would be entitled to add their wages, tips, compensation into the calculation. If they are a sole proprietor or Schedule C, there's much different. There's some different nuances that we'd need to talk about. So I think we're going to have a later call on that to give you some more detail if that's what you specifically were trying to get at. Another question from one of our listeners was, do canceled checks suffice as documentation? And what I would say is as we encourage people to open up a separate bank account, be very clear about recording things correctly, I would say that all documentation related to any of the covered costs that you're trying to claim should be really pretty clear. I like to think of it as how to make it as easy as possible for anyone who's reviewing your documentation to say, yes, this should be forgiven. I think we don't even know what the forgiveness process is going to look like. So it can be, I'm sure, pretty labor intensive as people have to dig through reams of documents. So you can do yourself a big favor by making it clear, making it easy, connecting all the dots for whoever's reviewing it so that it's really easy for them to say, yes, forgiven. Anna, here's one I'll send to you. Why do they base the loan on 2.5 months, but forgiveness on 8 weeks?
That is the $1 million question. So I think the way that if you take 2.5 weeks, 2.5 months, it allows for mortgage and the allowable non-payroll expenses to be factored in. So, if you look at the 25%, that kind of represents that extra week, I guess. I think that is one of the challenges, and I think that's I mentioned in the presentation is unless you're careful, I think a lot of people thinking they're going to walk away from this loan being free and clear, but through that calculation, unless you really have high interest expense or rent or utilities, or very highly paid employees that will, that get capped at $100,000. So highly paid employees, they're going to use, companies with highly paid employees are probably going to have no problem using up that loan amount. But those that have a mix may walk out of this with a loan on their books. And, coming with that loan is also, they're deferring payments for 6 months, but it's a very short window. So those payments can be pretty hefty. So you want to make sure that you're going in to it again with your eyes wide open with a loan calculator, or somebody advising you on what your liability is going to be, because you really don't want to default on a government loan. It just doesn't, even though there's no personal guarantee and no collateral, it's just not good. So you want to make sure that you're not walking out of this in 8 weeks with the economy still kind of, in the dumps. And now in addition to paying all your employees, now you have a pretty hefty monthly payment you have to come up with to pay the PPP loan back.
Yeah. Okay. So another question, and this is, I'm going to group a couple together. This is really around asking about some of the other covered costs, rent, utilities, and mortgage interest, and what really constitutes rent. you know, will things like rent, if I'm renting equipment, if I'm renting space for storage, if I'm renting, if I have a software subscription, is that considered rent? So, and what's interesting is there hasn't been a lot of additional clarity around those kinds of questions, but intuiting, based on the 3 categories that they pulled out as a covered cost, mortgage interest, which suggests mortgage would be on real property as opposed to a truck or you know, software. So I would say unlikely that those would qualify, but it was mortgage interest, rent, and utilities. And with utilities pegged to the rent, it does also infer that there is, you know, it's all based on renting real property, so offices and so on. But again, there hasn't been specific complete guidance on that. So, but my best guess is it would be for leases of property. Another question is regarding 401k and profit sharing calculation. That is profit sharing that's calculated once a year. And in this area, the SBA has clarified some issues, but not all of them, no surprise. They did clarify that employer contributions to these plans are not included in the $100,000 cap maximum. Okay, so that's a positive. They and also clarified if a company's making matching contributions during the months of April and May, and that's your 8-week covered period, those would be included in the forgiveness calculation. When we get into profit sharing contributions, you know, those are often made differently. So I think that it's going to be a question of timing. Certainly, you'd have more of a case, and again, I don't think it's been defined specifically, but you'd have more of a case if you made those profit sharing contributions during the 8-week covered period. If you make them after that, to me, it would be hard to claw them into that 8-week covered period. But again, there hasn't been specific guidance on the profit sharing. Okay, another question. Anna, which employer taxes are included in the calculation?
So right now, what's included in the calculation is the state and local taxes. Federal taxes are excluded from the calculation, but not removed from the calculation. That was one of the clarifications for the payroll calculation for the initial loan application. So we think that's going to be pretty consistent with, you know, the way that they the final guidance regarding the way that they calculate the loan application will also be the same way they're going to calculate the loan forgiveness, we think. Yet to be determined.
And there was a specific question on would workers' comp be forgiven? There hasn't been anything specifically discussed that would be included. And they did seem pretty specific around the wages, tips, state and local payroll taxes, which would include state unemployment fees, but nothing on workers' comp. So that may, it's likely that would be included. A question around, can I pay my employee I get the wording here, we allowed to give an extra check per employee as a bonus, and you know, I think as long as that's covered, that's an allowable payroll cost with all the same restrictions on it. Are you paying it during the covered period? You've got the 100K limit as a restriction. I think that if you pay it during that period, it seems likely that it would be covered, unless again they come out and specify that bonuses and things like that are not eligible, which we haven't seen anything like that yet.
Yeah, and I agree with that. I mean, I think how, there might be some of that needs to happen in order to make your employee salary numbers whole if you're looking for maximizing the loan forgiveness. So, yeah. You know, I think there's also some creative ways that you can figure out how to pay your employees, and I think we'll cover that in our next webinar on PPP.
Right. Okay. Someone asked the question is, when are they going to start working on forgiveness, and will it be done by the bank or the SBA?
So the guidance is definitely going to be coming out from the SBA because they are the ones who are going to have to forgive the loan. The the banks, I think, are going to have their own rules, like we saw with the application process. When you look at, when we looked across our clients and the documentation that each bank required, a lot of them had the same core. But they're also trying to cover their butts too, pardon my French. But we're not sure. The guidance is going to be coming out of what the calculation is. That's going to come from the SBA and Treasury. And I'll actually put in the notes in the chat a link to the page that we go to. We only look at the law, and we look at what's coming out of the Treasury and the SBA. And that's where we derive our guidance, because there's a ton of misinformation flowing around. There is a lot of interpretation from, probably every CPA and advisor has a different interpretation of the law. There's a lot of loan calculators going out around there, floating around. I would use things very judiciously, but I always go back to the SBA. Back to your point, who's going to provide the guidance? It's the SBA. And then the banks are going to interpret it for their own loans, and so they will provide guidance as to what they need specifically. One thing to be said about the banks and the SBA, like when you think about, as much of a pain in the butt this was to get those loans processed, for those of us, for those of you who have gotten money, congratulations. There's still a whole bunch of businesses behind you in the queue waiting for money. But the SBA, but the lenders are really not happy about this program. Think about the administration to actually get that loan processed, and then it's a 1% loan. These are not money makers for them. So they are going to try to get these things off their books as much as they can. So we want to make, so they're going to, try to get these loans forgiven. Both, taking another step back, when you put in your application, you basically, the onus was on you to say, yes, the information I'm providing is accurate. And the banks were kind of absolved of doing a tremendous amount of due diligence. They had to do a, quote, good faith effort for saying, yeah, we did a good faith effort review quick on this loan, and we think it's legit, so go ahead and back it, SBA. And that's all that was required. So the banks now are going to have these loans on their books. We think that a lot of people are going to try to hit maximum loan forgiveness, and then they will get off of the bank's books. But if you're kind of one of our clients and we're saying, hey, hang on, just let's take a slower approach potentially for this, depending on what you pay your payroll costs, but maybe over time, they're going to want to, they're not going to be loving that 1% loan on their books. So, so we just want to make sure we have everything documented in order, and so that you can continue to keep that loan in the bank.
And Anna, I would just add, I think a lot depends on what the forgiveness process looks like. To me, if it's a negotiated process, in other words, there's a give and take on, here's all of my documentation, what you won't allow that, but and you have the chance to explain the expenses, where you can really represent and help whoever is reviewing it understand why you believe those were part of an allowable cost, is one version. If it's just simply nope, it doesn't meet the standards, whatever those are, to the person who's reviewing its happiness, and there is no chance for rebuttal to it, and then it gets allowed or disallowed, then you're going to be in a different spot. So I think part of it's going to wait. There's a little bit of a wait and see as to how that whole process gets worked out. Not that I'm saying that you should throw in a lot of extra costs, hoping that somebody doesn't review it closely. I think you should always put in what's absolutely legal to put in. It's just a question of the reader and the reviewer and how they're going to interpret what it is you provide them. So, you know, more to come on that for sure. Another question is, are health benefits included in payroll costs? And yes, they are. Group health insurance costs are included in the applications we've seen. They're not part of the 100K per person cap. The banks are looking for good documentation on that. So copies of your invoices that you've paid for your health benefits. And you also have to remember to net any withholdings that you take out of your employee for their employee's paycheck for their contribution. You can only include the net number of health benefits.
Yeah, and I also think, you know, there's clarification that needs to go around that, because when you look at some of the salary and wages, you know, verbiage in the law, you know, it's kind of skewed towards actual like salary and wages as opposed to benefits. So I think, again, that is one other piece that is going to be clarified, because there's going to be some confusion around, you know, that component of it.
Yeah. And Anna, another question on the number of employees and how to understand what they're looking for. So this calculation was done preceding 12 months. There was an average of 9 employees. In their application, they only had 7 because they used the preceding 12 months. So they had already downsized a little bit, had 7 employees on February 15th. Do we only need to rehire 7 employees by June 30th?
Yeah, you know, that's really interesting. So I'm just going to float back to here. The payroll calculation, I mean, sorry, the reduction of employees, it is the look back period is based on that 215 time frame. So all of it is saying at the end of that 8 weeks, you're going to look back to any one of these 3 time periods, whichever gives you the best ratio, I guess. Was that the question, or is it related more towards the restoration of the employees?
The restoration of the employees.
Okay, sorry about that. Okay. So yeah, so it is basically going back to that 2/15/2020 timeframe. You know, another piece that is open to discussion is, okay, so it just distinctly says, you know, from February 15th of 2020 to really what it says is 30 days after the implementation of, or the enactment of the law, which is the 426. If you eliminate headcount between those 2 time periods, you know, and then you restore it by 6/30, you know, what happens if you reduce somebody on 5/1? You know, I guess if you just eliminate it by 6/30, you know, does that make a difference? So again, I think they're trying to be specific at the same time they created a whole lot more questions. I think we have time for maybe one more, Mel. Do we have any more?
Let's see. What are the chances that the bank forgives and then the SBA or IRS comes back a year later and disagrees?
You know, that is a question. You know, I think the bank has to get agreement, or basically the SBA is going to be buying those loans back from the bank.
In a way.
There's got to be an alignment between the two. That being said, I have a feeling that there's going to be a tremendous amount of auditing that's going to happen, maybe at the end of this, but you don't want to be caught, you know, on the wrong side of this. These programs were rolled out very quickly, but I also think there's a bunch of shysters out there that are knowing how, like, you know, we already saw some things on how to game the system. Make sure you're doing things in the spirit of the law and in good conscience. So, but that being said, I think you know, the banks and the SBA need to have agreement before that loan is forgiven, because the SBA is going to buy it back from the bank. Okay. And
Okay. And I think,
yeah, just one other thing that came out was, you know, the other thing that was discussed, that the loan forgiveness, normally if you get a loan forgiven, it's considered as income. That's exempt from income on your tax return for 2020. An interesting thing is you can get the loan forgiven, but the employee wages are also tax deductible. So you're going to get a double ding. So we expect some clarification around that as well. So lots and lots of interesting challenges that are coming out regarding this. Please, you know, if you're interested, we're happy to work with you guys and do a free complimentary consultation for 30 minutes just to talk to you about your specific situation. I'm sorry we couldn't answer everybody's questions so granularly, but if you're interested in, you know, sign up for our newsletter, but also stay tuned, and we'll do some more of these as things come out. Okay. I can't thank you guys enough for the great interaction and the great questions that we've had. Wish you the best of luck. Congratulations on getting funded. You are kind of some of the far and few between. And those of you who haven't gotten funded and are looking for this next round, we anticipate, well, you know, we anticipated yesterday afternoon, but, you know, we'll see how Congress comes out. We also are unsure if there's going to be additional restrictions around the money given the first round and how it was unfairly skewed, I should say, to larger companies. There may be some certain restrictions. So just stay tuned, listen, you know, you can follow us on Facebook and Twitter and all of that, and we keep our updates going. But also I put in the chat the link to the official Treasury page. It's not exciting reading. You probably would need a cup of coffee to get through it, but if you want the truth, go there. And just be careful of who you watch or listen to, and get advice from a professional who's following this. Not necessarily us, but just make sure you touch base with your tax accountant, or even there's some attorneys that are doing this, just to make sure that you're making the right decisions and not going afoul of the law. Okay? So thank you again, everybody. Thank you, Mel, for doing an awesome job of running our chat. And we look forward to seeing you guys either. Don't forget, we have our next webinars on Tuesday, on Thursday and on Friday. You can find those on our website, profitlink.com, and the webinar tab has all of our upcoming webinars as well as past webinars as well. Okay, thanks so much, everybody. Have a great day. Best of luck.